Back to the markets here. As we mentioned, stocks did stage a major intraday reversal despite the geopolitical uncertainty. Our next guest says a market that is hedged for conflict suggests that market upside is delayed and not derailed. Joining us now here on set is Julian Emanuel, Evercore ISI Senior Managing Director. Julian, great to have you with us. There's so many risks involved still with this conflict, even though the markets basically shrugged it off today. So what point do the markets care?
Well,
what triggers that?
This is going to be ongoing, okay? If you think about what President Trump said earlier today or perhaps yesterday, the window is 4 to 5 weeks of uncertainty. We'll see how events unfold. But when you think about the market action, frankly, and Mike pointed this out earlier, what is this now? 40% of the days we've crossed 6,900 either way. But in reality, both the NASDAQ and the S&P 500 have been range-bound for 6 months almost. And to us, the message here is, as much as there's been angst around consumer staples outperforming, financials underperforming, software, we know, worse than underperforming, and in fact, all three of those went the other way today, the message is that there's still demand for stocks, the economy is still strong, $70-something oil isn't going to be a significant headwind. Could go higher, we don't know. But the backdrop remains favorable.
I can envision tomorrow morning seeing some of the assessments of today's action saying, like, well, I mean, this is clearly just counter-trend, short-covering stuff because the most beaten-up parts of the market did get a bid. C3 AI, which is like left for dead, is the biggest gainer in software, and therefore trying to discount it. What would you answer to that?
So there's two things. Number one, there is an element of counter-trend because basically, if you think about it, right, we're just starting the third month of the year, okay? And if you're a hedge fund or an active investor, you're really not going to put out gigantic bets here because the uncertainty is so high. But what you might do is cover the shorts that have worked and trim some of the longs that have worked as well. And I think to a certain extent, that's what we've seen today. And then the other aspect of it is actually, and this is fortunate in a way, the options market, both in terms of stocks and in oil, was telling you that you were very, very hedged coming into the event. You know, almost record bearishness in the price of puts versus calls in the triple Qs and the SPYs, and almost record bullishness in the price of calls versus puts in the USO, the oil ETF. We were ready for this.
In terms of what breaks us out of this range, though, Julian, we will return eventually once the markets sort of come to grips with what's going on in the Middle East, come back to the prior issues that bogged the markets down, namely private credit concerns in the software space, et cetera. How do you see the path to overlooking those concerns? So,
and we've seen this time and again. We saw it in late 2015, early 16, with concerns around credit in the oil patch at that time. The same concerns around high-yield technology here, but the bigger picture is there hasn't been an infection into the rest of the credit markets, and that tells you that the economy is ready to continue rolling along. And we've talked about this before. The math drives this. You're not going to make new all-time highs without technology. The good news is we think you're going to have technology.
I know that you're certainly put your faith in earnings growth, which has been strong, and it looks like it's going to continue that way. But this has been the second quarter in a row where S&P 500's blasted through the estimates, 5 percentage points better than expectations, into the low double digits, and the S&P's where it was in the middle of the last earnings season.
And that's okay because, look, this has been an expensive market valuation-wise in terms of, 30 years worth of history for almost a year now. So in a lot of ways, this is just earnings catching up to price. And we feel like when both sort of do their thing, we will end up breaking to the upside in terms of price.